interesting conversation lined up for you. Goldman Sachs remains bullish on the power sector stocks such as Power Grid and Hitachi Energy. The brokerage also says that the Indian transmission sector will have the second largest share with more than $500 billion of spends. We have Nikhil Bhandari, the head of Asian Equity Research and co-head of APAC Natural Resources and Clean Energy Research at Goldman Sachs to discuss further. Good afternoon, and it's an excellent note. We had a chance to go through it. First up, give us a sense of how is the power sector outlook according to you. What kind of spends are you seeing? If you could break it up, maybe first for the next decade, and which themes, according to you, are the sectors to look at?
Sure. Thank you so much for having me on the show. So just to give a bit of context, we started a more dedicated research on clean energy sector in India last year. We highlighted how round-the-clock renewables are a critical but not a sufficient solution to India's challenge of balancing economic growth with decarbonization. We also highlighted how India's global leadership in renewables cost is driven by not just by natural factors like sunlight hours or the wind speed. It is also driven by its fully integrated national grid. Now, so building upon that, in the report that you mentioned, we have put some more numbers to it. We believe nearly 1/3 of the overall energy transition capex required is going to be going towards the power transmission complex. In terms of billion by 2050, we expect the total energy transition capex to be about $1.7 trillion, and out of that, roughly 30%, which is over $500 billion, will be allocated towards the power transmission sector. So, in terms of how do we think about the companies and the developers in this space, we are focused on we're looking at companies with larger balance sheets, relatively lower cost of debt, and companies who have the cutting-edge transmission equipment technology. So those are the key areas that we have covered in the report, but I'm happy to go into different aspects in more detail.
Oh yes, Nikhil, and I know you will not be able to talk about specific stocks, so let's keep it at macros and understand what, according to you, in the renewable side of things, will be seeing capacity addition on an annual basis. What kind of levels are you envisaging there?
Sure. So if you look at the renewables sector today in India, roughly the run rate of capacity addition per year between solar and wind has been in total 15 to 20 gigawatt per year. We believe this run rate could nearly double by the end of the decade to 30 to 40 gigawatt addition. These numbers I'm talking about more at the grid level. Outside the grid, we believe there is an opportunity of in total about 400 gigawatt of renewable capacity that can be deployed for the requirements of corporate and industries decarbonization, C&I, as well as the agriculture solarization. So at a grid level, we are at 15 to 20 gigawatt. We go to 30 to 40 by the end of the decade. This totals up about 400 gigawatt at a grid level by the end of the decade. Outside the grid, there is another opportunity of 400 gigawatt in the C&I and the agriculture space.
Nikhil, first of all, just as we get into and as we aggressively ramp up renewables, like you just mentioned, let's also touch upon how exactly are you expecting thermal capacity addition, and do you see any opportunities there also for some of the listed players? Of course, you can't name names because given the fact that India has consistently over the past year and a half gone ahead and increased the thermal capacity addition guidance. So the latest number that's come out is almost 88 gigawatt of thermal capacity guidance. So would you also feel that some of the names earlier which were written off, some of the capital goods companies, some of the companies that are making equipment for capital goods, is that also a way you feel that we can look at playing this particular theme?
Sure, that's a great question. So the government recent target on a cumulative basis to 2032 is closer to 88 gigawatt of coal capacity addition, coal-based power plant capacity addition to come through. If you look at that number, there is about 30 gigawatt, which is already under execution. In order to hit that 88 gigawatt number, we think ordering needs to happen in the next couple of years, because after that, we need a few years for environmental clearance, land acquisition, PPAs to be signed, and then build up of these power plants. In our view, even if we achieve 70 to 80% of these goals by 2032, we still think there will be a net power supply demand deficit in the system because the electricity power demand has been growing at a very rapid pace. So one of the themes we've been highlighting last year is that there will be a revival in the thermal power plant capex cycle that will benefit the power generation companies because on one hand, we do think round-the-clock renewable is an attractive solution, and that will become critical in terms of India's power sector. But at the same time, given the pace at which electricity demand is growing, we will need a lot more thermal coal capacities as well, and that capex cycle has already started last year. So again, both round-the-clock renewable and thermal will take the front seat here in terms of the capacity addition, and companies developing these areas of power will be the key beneficiaries.
Okay, so Nikhil, within renewables, which do you think is best suited to aggressively add capacity? What kind of returns do you see there? Is it better to add capacities in the thermal direction or renewables?
Sure. So look, solar-based renewables are already quite attractive on the power cost curve in India. The cost to generate solar power is nearly 2 rupees per unit of electricity versus the industrial customers are today paying 6 to 8 rupees per unit. However, solar is intermittent. If you want to make it round the clock by being creative, adding solar plus wind plus some storage, or make it solar plus a lot of storage, either way, to get a round the clock 24/7 electricity, we can still compete in the power cost curve because those RTC, round the clock renewable project, are costing about 4 to 5 rupees per unit. And with these RTC projects, we believe the IRR could be closer to 20%. So for plain vanilla solar projects, which are intermittent, do not fully solve the power deficit situation, the equity IRR has been slowing to low teens, but for round-the-clock solar with either wind plus battery solutions that can guarantee 24/7 power, the returns are more attractive at closer to a 20% equity IRR.
Right. Nikhil, one more question from our end. You've said, and you've distilled the amount that India's power transmission capex is expected to be almost $500 billion over the next 25 years. Can you distill that us, further in terms of, what will be the power transmission player? Mostly in India, it has to be, the beneficiary has to be Power Grid. Now also coming lower to names like Hitachi and some of the names, of course, you cannot speak individual companies. But what will be the pie that they will be able to get? And also one word on smart metering opportunity, because that too is something that there is quite a lot of spends currently on.
Sure. So again, I'll not talk about the stocks individually, but in terms of the overall transmission capex opportunity, we are talking about $500 billion plus by 2050. There are three main components to it. One is the capex that will be required just for the grid level of the renewable capacity, which we expect even after 2030, we expect additional 900 gigawatt of renewable deployment by 2050. In total, that itself needs about capex of close to $350 to $400 billion. On top of that, we believe there is a CNI, corporate and industrial decarbonization opportunity. That conversion of gray to green power will require additional about $50 billion of capex. And lastly, the green hydrogen, where we expect 43 million tons of green hydrogen capacity by 2050, partly for domestic market, partly for export. Given the biggest cost to make green hydrogen is electricity, and we need round-the-clock clean green electricity to make clean green hydrogen, that will require additional about $90 to $100 billion of capex. So again, this is how we are building up the capex SAM. Of course, in the report, we have distilled it further into how much is it for just the grid equipment level, the medium distribution line and the high voltage distribution line. But that's how we have built up the addressable market. In terms of the smart metering, we haven't written anything published around it. It is still broadly at an early stage, so we haven't tamped it up in terms of the addressable market. I think the bigger opportunity at this point, based on our work, lies in the transmission grid and the equipments related to that.
Take that point, Nikhil. It was a pleasure having you with us on the show, and we'll speak again when you have an idea on the smart meter opportunity as well. So that calls for another conversation. We'll do one thing, we'll slip into a break now. When we return, we'll be joined by the management of Nelco to discuss their Q4 numbers. Stay tuned.